Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 30 in our series for 2024, and today's date is Friday, August the 23rd. First, I'll be talking to the Director of WorkdforClimate, Lucy Piper, on the issue of how many of Australia's leading companies like Rio Tinto, BHP, Qantas, Coles and Woolworths and more are obstructing and delaying Australia's transition to net zero by lobbying against climate action. Despite their ostensible commitments to net zero, they are in reality greenwashing, even gaslighting. And I'll talk to Indeed economist Callum Pickering about the latest unemployment figures and whether these point to rate hikes instead of rate cuts. But first, let's talk to Lucy Piper.
Well, Lucy, there's been a whole lot of issues about the climate and businesses now reporting and lobbying against the net zero. And so what's actually going on?
Well, there was the climate integrity report, which was released back in, I think it was the end of May. And that shows that despite making multiple commitments to sustainability and climate action, companies in Australia are lobbying our government to prevent progressive climate policy and regulation from actually occurring. So it's what we would refer to as greenwashing. On the one hand, we're saying that we're going to do something, and then on the other hand, lobbying behind the scenes to try to prevent regulation from allowing those changes to happen.
It's actually gaslighting.
Your term, not mine, but yes, I would agree.
Right, okay. So what are these companies?
Well, in the climate integrity report, I believe they highlighted about 9 companies. Off the top of my head, you had Coles and Woolworths in there, Qantas were in there, Rio Tinto, BHP, and a couple of others that I would have to look up. Don't have them in.
That's huge.
Yeah, I mean, my understanding is that the organization that were leading the research wanted to look into the biggest household names and companies in Australia to get a clear picture of what are they saying versus what are they really doing behind the scenes to take action on climate. And we can see that despite making commitments around emissions reductions, because those companies all have net zero targets, what they're doing behind the scenes is they're using their influence to try to shape government policy in a way that's going to prevent any meaningful action from happening in the short term.
Right, okay. So what's stopping them? Is it costs? Because companies these days don't want to spend money in this economic climate.
Absolutely. I think that anyone that's worked in this space for a little while has clarity around the concept that it is going to cost us money in the short term if we are going to prevent catastrophic climate change and global warming from happening. It's going to cost us money in the short term, but we need to take action in order to prevent long-term bad things from happening in our economy, in our society. Unfortunately, the way that businesses and the economy are set up are such that quarterly profit targets, quarterly reporting is what our businesses and the corporate sector orient towards. So there's this real tension between, okay, this is what we need to do for the long term. We need to achieve net zero carbon emissions by 2050 as per the Paris Agreement and the IPCC science. That is what the science tells us. What that means we need to do is reduce our emissions starting now. We need interim targets. We need to get to achieve 2050 net zero. We realistically need to have 50% emissions reduction by 2030. That's 5.5 years away. And there's not the action taking place within the corporate sector to get us anywhere near to where we need to get to. I believe the current projections are around a 2.4, 2.5 degree temperature rise this century. We're already averaging 1.5 degrees for the past best part of this year, it's not looking good. And we need every sector of society to be pulling their weight. And the corporate sector contributes massively to our global emissions. And that tension between we need to make money now in order to hit our revenue targets, in order to fuel our economy, that short-term goal is what is preventing us from achieving that long-term target.
So what can these corporates actually do to address this issue? I mean, what do they need to do to take the lead on this?
I mean, the companies that were highlighted in the climate integrity report, some of their sustainability targets and initiatives on the outside are what you would say is taking the lead. They have the right targets in place, but it's that lobbying behind the scenes that is the gap, the integrity gap. So that lobbying behavior, they need to be using their influence to put pressure on governments and policymakers to create the regulations that will make this a fair playing field for all companies to go all in on climate, not just the ones who are super progressive and who it's easier for to make commitments and reduce emissions. There are industries and sectors that it is very difficult for them to be able to rapidly reduce emissions without short-term costs. So we need companies to not just make sustainability commitments and claims. We need them to walk the talk. We need them to use their influence and advocate, use their lobbying dollars and resources to create the enabling conditions within our government, with our policymakers, to get the regulation in place.
So it's not so much them spending extra money, it's in terms of them using the money they're now using for lobbying to lobby to get the right conditions to get this.
Correct. I mean, to your point around spending money, we do need to see companies investing CapEx in climate goals and raising their climate ambition. That's the first part. But then this lobbying part, they are already spending money on lobbying. They are already members of trade associations who are lobbying on their behalf against climate policy. So having an eye to that side of how they're using their influence and how they're advocating for climate. Another thing that was highlighted in the climate integrity report was the fact that there is this future legal risk to organizations and company directors if they're not aware of the lobbying activity that their company is either supporting as part of a trade association or is directly doing, that is creating that gap between here's our climate commitments and here's how we're preventing action from taking place. There is potential for them to be open to legal risk down the track. So that's another thing for consideration.
Well, there is a potential for class action. Would that be right?
I mean, my understanding, and I'm not a legal expert, but there are case studies of ASIC, with the greenwashing case that was recently brought about, and ACCC. Regulatory boards are they're cracking down on this. Companies cannot just say, oh, we're going to do all these things and then act completely differently. It is not what consumers want. It is not what employees want. It is not what shareholders and investors want, because it means that funds could be allocated in the wrong places. So that's where my understanding of the legal risk kind of comes down the track.
Well, ASIC is actually cracking down on greenwashing.
Yes, correct.
Right. Okay. So they are running a huge legal risk.
Exactly. The legal risk to company directors, if they are not across what their corporate lobbying activity and what their corporate affairs teams are either doing directly or, like I said, indirectly via trade associations who are lobbying on their behalf and on behalf of industry, it's just going to open them up to, like I say, that the integrity gap between what we're saying and what we're actually doing.
So we'll have to watch this space very carefully over the next year or so.
Absolutely. And I think that awareness around this lobbying piece is really critical. Most people have no understanding of it. So the fact that we're having a conversation about it and people are starting to read the report and talk about how corporations are lobbying governments, I think it's a good step forward.
Well, Lucy, that's all fascinating and important. And thank you very much for your time.
Thank you so much, Leon.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, unemployment went up to 4.2%. What's your assessment of the figures?
Yeah, a bit of an increase in the month of July, but I don't necessarily think it's quite as bad as it first appears. Obviously, we'd prefer the unemployment rate to be lower, but it was driven primarily by increasing participation in the workforce. Australia's participation rate increased to a record high of 67.1%, and that was driven by very strong employment gains. So employment was actually up around 58,000 people in the month, which is an outstanding result at this point in the economic cycle. So I wouldn't be too concerned around the unemployment rate result at this point, particularly given just how strong some of the other labour market metrics are.
Right, okay. And but a lot of it was driven by migration?
Well, certainly migration is driving population growth. And that's one of the reasons why we have this odd situation at the moment where employment growth over the past year has been absolutely outstanding. It's increased by around 455,000 people. And that is one of the biggest results we've ever seen outside of the pandemic volatility. And yet, despite those really strong gains, we've actually seen the unemployment rate increase by 0.5 percentage point over that time. That's purely because, well, it's not purely because, but it's largely because of very strong population growth. So there's a lot of people coming into Australia. Most of those people are finding jobs, which is why employment gains are so strong. But those gains haven't been strong enough to keep the unemployment rate from rising.
But it's not so much a case of people losing jobs.
No, absolutely not. And I think that's a really important point because when we think about rising unemployment, we think about people losing their jobs, right? But in most cases, it actually arises because of population growth. That is that job creation doesn't keep pace with population growth. So employment's still rising, it's just not rising enough. And that's what we're seeing at the moment, albeit a sort of very different dynamic than what we normally see. Because in the past where we've seen rising employment and also rising unemployment, it's been when employment has been rising at a pretty modest pace. At the moment, we're seeing historically strong employment growth, and yet the unemployment rate's still rising.
And these are all in full-time positions?
Well, certainly in the month of July it was. So while overall employment was up around 58,000 people, full-time employment was up by a touch over 60,000. So in the past few months, we've seen some really strong full-time employment gains, which is a good result. That's another sign of strength because a strong economy and a strong labour market is one that traditionally produces a lot of full-time opportunities. So the jobs that are being created are of high quality at the moment.
How much of its employment was in the private sector and how much of it was in the government sector?
I can't answer that from the
okay.
From the ABS data. Sorry.
Yeah.
It doesn't have that breakdown, unfortunately, in the monthlies.
I thought that was interesting because the government's putting on a lot of work, and the private sector seems to be slowing.
Yeah, there is a dynamic at play, and we didn't get an update on that in the July labour force figures. But what we have seen over the past year is that a lot of the job creation that is taking place has been in either the public sector or in government-aligned industries. So we're talking about industries such as education as well as healthcare, and they have been driving employment gains, particularly recently. Now, what that is telling us is that there's very different dynamics in terms of what we're seeing from the public sector versus the private sector. The public sector doesn't tend to be as influenced by market dynamics, okay, because they're financed in different ways. And so while private sector businesses are struggling a bit, the economy has been a bit weaker, maybe revenue and income isn't quite as strong as it has been in the past, the public sector can sort of just ride through that. They're not influenced anywhere near the same degree. And so they can continue to hire doctors and nurses and educators and all those types of jobs without worrying about those market dynamics. So I think that's a really important point. It does highlight that the private sector is beginning to struggle, that dynamics have shifted there. But at the moment, the public sector has sort of filled in that gap through all the hiring that they've been doing over the past 12 months.
Now, what about underemployment?
Well, underemployment actually dipped a little bit in the month of July, which is always good to see. It declined down to 6.3% from 6.4% a month earlier. Now, one of the reasons why we have seen declining underemployment in the past few months probably relates back to all the full-time jobs that have been created. There's a lot of, people can find the hours that they're looking for. And as a result of that, even though we have seen unemployment increase, the rate of underemployment is coming down at the same time. So look, I think that's a good outcome. We know that with cost of living pressures, a lot of people are looking for more work, more hours. And at the moment, people seem to be able to find that.
Right. Okay. But what's interesting too is how the RBA will take these figures. I mean, the rise in unemployment is pretty much in keeping with RBA projections, isn't it?
Yeah, that's right. You could possibly say that it's ever so slightly above the latest RBA forecast, but certainly not meaningfully so. I think, normally when we think about how the RBA thinks about this, we think, well, they're probably going to focus on the unemployment rate. But I think in the current situation, they're probably going to place more emphasis on employment, because employment is going to be driving domestic demand. And the problem with the RBA has at the moment is that domestic demand is still too hot. It's hotter than they want. And domestic demand is what's driving, inflation, at least some inflation. So they want to bring that back. So I think the fact that employment is growing rapidly, like I said, up 58,000 in the month of July, up over 300,000 in just the past 6 months alone, indicates that the economy is still creating a lot of jobs. Domestic demand is probably higher than the RBA would prefer. All of these employment gains are going to put pressure on inflation. And so from the RBA's perspective, this may not be enough to make them hike rates, but it certainly means that a rate hike is still a potential outcome. It's certainly on the table if other measures of economic activity, particularly the inflation figures, confirm that the economy is still running a little bit hot.
Right. But so we've got to wait till the next quarterly numbers, which coming out towards the end of the year.
Well, certainly the quarterly data will be important, but the RBA also will look at the monthly figures on inflation. Those figures can be a little bit volatile. They can be a little bit difficult to read from month to month, but certainly the RBA will be watching those closely to get a sense of whether the inflation signal is shifting, whether inflation is likely to moderate in those quarterly figures. But ultimately, what all this means is that monetary policy remains data dependent. The RBA doesn't have a firm bias in where they're likely to go next. It's going to be determined by the data flow. So these employment figures, they suggest that maybe the next move should be up. Maybe the inflation figures out towards the end of this month will say something else. But if all the data aligns, if all the data is too strong or not moving in the way that the RBA wants, then you're likely to see rate hikes.
Right. Okay. So we need to watch that very carefully, because a lot of people are predicting rate cuts next year.
Well, certainly that's a view of a lot of people. I'm certainly probably sitting on the fence a little bit here. I think it can go either way, in the sense that you can create a pretty compelling argument for either rate hikes or rate cuts. One of the things that I've always said is that there is a pretty big disconnect at the moment between wage growth and productivity growth. That is, wage growth continues to be very strong. It's still above 4%, whereas Australia's productivity performance has been pitiful, terrible, amongst the worst we've seen in a very long time. Now, ultimately, that's going to make it difficult for the RBA to return inflation back to target on a consistent basis. It may not stop inflation from getting there initially, but staying there could be a very different problem. So the RBA is going to be closely watching measures like that to get a sense of whether they can actually achieve their target on a consistent basis. And a lot has to change for that to occur. I think some people who are focusing on the rate cut argument are maybe looking a little bit too short term. I can see the argument. The economy is doing not great, although it may still be a little bit overheated. But you also need to think about things in sort of a longer term fashion as well, which comes back to arguments around wages versus productivity growth and whether that dynamic is consistent with the RBA's 2 to 3% target. At the moment, that's not the case.
And so if inflation were to come down, it would be some time, this is according to the RBA projection, would be sometime in 2025, getting closer to 2026.
Yeah, they certainly don't expect it to happen anytime soon. I mean, we're talking about at least another 18 months of above 3% inflation, even longer to get back to the middle of that inflation target. And one of the things I'd probably also add to that is that the RBA is forecasting some pretty strong productivity growth as part of that outlook that they're putting together. If productivity growth doesn't evolve the way the RBA expects, then good luck meeting their inflation forecasts, because they're going to miss by a long way. So those forecasts are based on some pretty strong productivity estimates. So it'll be interesting to see whether that sort of actually happens or not, because it'll play a big role in how monetary policy evolves.
So what's your projection for future jobs figures moving forward?
Well, I mean, there are a range of labour market metrics that do appear to be softening. Job vacancy figures, for example, Indeed's job posting metric as well certainly points in that direction. But employment growth remains incredibly strong. past 6 months, we're talking about over 300,000 people joining the workforce. And in a normal year, that would be considered an outstanding result, let alone one for 6 months. Now, realistically, those employment gains are going to slow at some point. You can't continue at this pace. So we'll certainly see a slowdown in employment growth. But, it's still a very, very strong gains that we're seeing at the moment, given the overall economic position we find ourselves in at this point in the economic cycle. So I think that's another argument, I think, in favour of potentially hiking rates, is that the job market is still very, very strong.
So we'll watch out for that very closely, Callum.
Absolutely.
Well, thank you very much for your time again.
Thanks, Leon.
So what's happening in the news? Well, plummeting iron ore prices could cost the federal government $3 billion in revenue, which is likely to push the budget further into deficit this financial year. China's property market is in a precarious state, which has seen demand for iron ore, the key component for making steel, drop significantly. Iron ore prices at the start of the year were around $143 per tonne and have been gradually declining all year. But that decline has accelerated in recent weeks, with prices now sitting around $82 per tonne, which is below the price the Treasury had anticipated at this point. It had forecast the iron ore price gradually declining to settle at $60 per tonne by the first quarter of 2025. Treasury analysis finds that if prices fall to that level in the current quarter, which ends in September, instead, it would mean a loss of $3 billion in tax receipts over the next 4 years. The government was already expecting to post a deficit of $28 billion for the 2024-25 financial year, after delivering surpluses for the last 2 years. The Treasury often makes conservative forecasts on iron ore prices, which has meant the federal government has regularly received more revenue than it planned for. But now, with the iron ore prices falling faster than expected, Labor faces the prospect of less revenue and a bigger deficit as it heads into an election year in 2025. In a statement, Treasurer Jim Chalmers described it as another reminder that we are not immune from volatility and uncertainty in the global market. The federal government will be hoping the jobs market remains strong, with continued low unemployment meaning more revenue for the government via income taxes. And federal leave has been called in to investigate whether Regional Express's former chairman and major investor illegally recorded the company's final board meeting amid increasingly bitter recriminations over the airline's collapse late last month. The Australian Federal Police confirmed it had received a report of a potential crime last week, and the company's chairman, John Sharp, had spoken to investigators examining misdemeanours at Regional Express, known as Rex. The report to the AFP alleged that Lim Kim Hae, who was deposed as Rex's chairman earlier this year and controlled more than 50% of the register until administrators at EY were called in on July the 31st, illegally recorded the final board meeting. But those claims come amid a serious falling out between Mr Lim and other directors, including Mr Sharp. Mr Lim was removed as executive chairman with little explanation in June, and later pushed to turf the company's entire board. Rex was rescued out of the collapsed airline Ansett and its regional subsidiaries, Hazelton and Kendall Airlines, in 2002. While many other airlines have failed around it, most recently low-cost carrier Bonza, Rex had succeeded in staying afloat, even flourishing. In 2021, it secured the backing of PAG Asia Capital, which gave it a $150 million line of credit that allowed it to expand into capital city markets. Since its collapse, those services have ended. The federal government is guaranteeing flight bookings made during the administration process. EY is hopeful of selling the airline. It is brought on corporate advisors Houlihan Lokey for the process. Part of the animosity in the boardroom has been attributed to dealings with Virgin Australia and its private equity deal with Rex, including just months ago, to take on the capital city business and the 9 Boeing 737s flown by the airline. Those agreements never proceeded. When Rex fell into administration, Virgin agreed to take over 3 of Rex's 737 leases. The others have been handed back to their owners. Rex's regional business is the largest owner of Saab turboprop aircraft in the world, although it needs significant new funding to overhaul the ageing fleet. EY has told creditors that Rex owes around $500 million, including $120 million to PAG and $170 million to Westpac, although that is fully guaranteed by government contracts related to the ambulance service Pellair, a subsidiary of the airline. And disgraced construction union leaders could be banned from their jobs for life after Labor and the Coalition struck a deal giving an independent administrator control of the CFMEU for at least 3 years. The compromise law was thrashed out on Monday in response to a litany of issues exposed in the media, but the bill, which passed Parliament on Monday night, could be challenged by the union in the courts and will test the expected administrator Mark Irving KC's ability to turn around a union with deep-seated loyalties and a militant culture. Workplace Relations Minister Murray Watt said the law would turn around Australia's $269 billion construction sector. After weeks of public sparring, Labor agreed to coalition demands to require 6 monthly reports to Parliament from the administrator, a 3-year minimum administration, and lifetime bans for dodgy unionists. The coalition failed to extract a legal guarantee barring union political donations, settling instead for an assurance from Irving that they would not occur. Only the Greens opposed the bill. All state and territory divisions of the union will be forced into administration as early as next week, Watt confirmed. Opposition leader Peter Dutton's move to table a bill to bring back the union watchdog scrapped by Labor, the Australian Building Construction Commission, and another allowing lifetime bans for corrupt union officials was knocked back by Watt, who said it would be a witch hunt against all unions. Senator Jackie Lambie used parliamentary privilege to accuse major contractors of working with the CFMEU to engage in price fixing on government projects and alleged that construction workers were being forced to join the union to work on them. And self-funded retirees will be asked to pay more out of their own savings for their aged care under a deal to be struck between Labor and the Coalition that will chart a new course for the care of older Australians. Legislation giving effect to the changes have been largely agreed between the parties and, barring last-minute politics, could be put to Parliament as early as Thursday. The new laws would see wealthier older Australians privately funding more of their daily living expenses while in aged care. Those not drawing a government pension would be paying more for nursing home rooms, meals and everyday living costs, such as cleaning, while those receiving in-home care packages would contribute more of their own money for services such as home maintenance and gardening. The new Aged Care Bill is the Albanese government's response to a number of elements of the Aged Care Royal Commission and its own task force that examined the financial sustainability of a beleaguered sector in which currently half of all nursing homes are operating at a loss. It is expected to come into force from July next year, but under grandfathering arrangements, existing nursing home residents are understood to be exempt from the changes. For home care, the greater co-contributions are not expected to come into effect for a further 2 years to allow for a transition. And collapsed bookseller Booktopia has been rescued by the owner of online camera store digiDirec. McGrath-Nicol administrator Keith Crawford said he was incredibly pleased to close the sale and that the transition of Booktopia to another Australian e-commerce retailer was a great outcome for the business. The transaction will result in the retention of all remaining employees, the recruitment of some 100 additional employees, and continuity of supply of Booktopia's trade creditors, he said. However, the sale price, which was not disclosed, does not cover what creditors are owed. A second creditors meeting will be arranged, with details to follow. And banks are spending hundreds of millions each year to keep cash in the branches, and they want you to know it. CBA, the biggest bank in the market, has made the unprecedented move of using its annual results presentation to detail how much it costs to keep cash in the branches. The new CBA report says monthly cash ATM withdrawals have plunged 50% since 2018. At $350 million per annum, the bank describes the provision of cash services as a challenging commercial model. The enormous bill for cash will serve as ammunition for the banks when they face a House of Representatives committee later this month, which is set to examine the vexed issue of cash services. Consumer activist group Cash Welcome is calling for new regulations that would mandate big banks to provide cash and big retailers to accept it. Separately, there's been an independent members' bill put before Parliament calling for fines against businesses that do not accept cash on amounts below $10,000. At the heart of the matter are older Australians, many in regional areas, who want cash for everyday use, with nearly 20% of over 65s classified as high cash users. Bank CEOs such as CBA's Matt Coman and ANZ's Shane Elliott are navigating a fine line between managing the shrinking and increasingly expensive business of providing cash, with fears that regulators could intervene and dictate terms by mandating cash services. Banks have publicly admitted to not holding any cash in some branches, a change which prompted a social media uproar in recent times after ANZ customers realised select branches did not carry cash any longer. And the profit reporting season continues. Suncor's full-year net profit jumped 12% to $1.2 billion. Westpac has posted a $1.8 billion unaudited net profit for the 3 months to June 30, up 6% on its quarterly return in the first half. Ampol has recorded net profit of $235.2 million for the half year. BlueScope says its FY24 sales revenue dropped 6% to $17 billion on lower steel prices. Underlying net profit decreased 22% to $860.7 million. Property giant Lendlease reported a 10% decrease in revenue in fiscal 2024 to $9.4 billion from a year ago. After-tax losses deepened to $1.5 billion from $232 million. In the first month of 2024, Media reported a profit of $18.2 million, down 11%. Property giant GPT Group has recorded a net loss of $249.4 million, according to its half-year results. Financial software provider Iris earnings rose 52% compared to the previous half to $67 million. Investigation software provider Nuix reported a statutory profit of $5 million for FY24, compared with a loss of $5.6 million for the year prior. Bathroom and plumbing products company Reece Group has lifted net profit after tax by 8% to $419.2 million for the 12 months ended June 30. GWA Group Limited has reported a 3.4% rise in normalised net profit. Retailer Baby Bunting posted a tiny $1.7 million statutory profit in fiscal 2024, 83% lower than a year ago. Construction group Monadelphous delivered a 16% increase in annual net profit to $62.2 million. Metal recycler Sims swung to a net loss of $58 million in fiscal 2024 from a profit of $181 million a year ago. Hub24 earnings for FY24 came in at $118 million, up 15% on FY23, and profit rose 24% to $47.2 million. Plumbing supplies group Reliance Worldwide Corporation suffered 21% slide in annual net profit after tax for 2023-24 to US $110.1 million. Detero Royalties posted a net profit of $154.9 million, up 1.6% on the previous year. Dexus reported a net loss of $1.58 billion compared to a statutory net loss after tax of $752.7 million in FY23. Medical glove and surgical protective suits maker Ansell's net profit slipped 49% to US $76.5 million for the 12 months ended June 30. Judo Bank has ruled off a slight fall in annual profit after tax to $70 million, but lifted its underlying profit before tax by 2% to $107.5 million. Shopping centre giant Vicinity's annual net profit soared 67% to $547.1 million. Mining service group Parenti's statutory net profit of $107.2 million was up $4.6 million on FY23. Car parts merchant ARB reported a 17.1% jump in profit of $142.7 million. Helia Group reported a statutory net profit after tax and NPAT of $97 million and underlying NPAT of $106.5 million. Ingenia Communities Group reported a profit of $14 million, up 78.2% on 2023. Santos has posted an 18% drop in first half underlying profit to US $654 million. Domino's Pizza posted a full year net profit which was up 136.5% to $96 million. Insurance giant IAG's net profit gained 9% in fiscal 2024 to $900 million. Fletcher Building swung to a loss of $227 million in fiscal 2024 from a profit of $235 million a year ago. AUB Group forecasts underlying net profit in the range of $190 million to $200 million for the 2025 financial year, which represents growth to 16.9% over FY24. Pallet maker Brambles' operating profit gained 19% to US $779.9 million. Breville reported a 7.5% increase in full-year net profit to $118.5 million. Alternative asset manager HMC Capital lifted pre-tax operating earnings by 57% to $129 million for FY24. WiseTech statutory profit rose 24% to $262.8 million. Struggling pathology company Helios reported a loss of $645.8 million in FY24 compared to a loss of $367.8 million in FY23. Cleanaway Waste Management's full-year net profit jumped to $158.2 million from $23.5 million. Superloop has narrowed its annual net loss to $14.7 million. Sky New Zealand's net profit fell 3.7% to $49 million in fiscal 2024. Redbubble store owner Articore Group reported a net loss of $8.8 million, a $45.3 million improvement on 23's figures. Data3 reported a 17% increase in full-year net profit to $43.3 million. Network service provider Service Streams profit was $50.1 million, up 36.4% on FY23. Mining tech companies Index's net profit fell 2% to $55.6 million. PEXA, which built a platform used to settle most Australian property transactions, reported a rise of 16% in operating earnings before interest and tax, depreciation and amortisation to $115 million. The Lotto Corporation, which owns the gaming brands like The Lot, Keno and Powerball, posted a net profit of $414 million for the year to June 30. Hansen Technologies' statutory net profit halved to $21.1 million from $42.8 million a year prior. Peter Warren Automotive reported a 30.6% slump in full-year underlying net profit to $56.8 million. Property fund manager Charter Hall has posted a near 19% drop in its operating earnings of $358.7 million for its 2024 financial year. Contractor Venture Services has delivered a 15% increase in interim net profit to $101.4 million. Cedar Woods Properties reported net profit of $40.5 million for the 2024 financial year. Cleanaway Waste Management's underlying net profit grew by 14.8% for the period to $170.6 million. Corporate Travel reported a 22% increase in underlying net profit to $113.3 million in the 2024 financial year. And that's it for this week. And next week I'll be talking to Dana Udall, the Chief Clinical Officer for the Headspace app, which is a leading provider of meditation and mindfulness wellbeing solutions with over 100 million users, 30 million of those from the Headspace for Work partnerships with over 4,000 global enterprises. The Headspace apps continues to rank in the 10 most downloaded health and fitness apps in both Apple and Android stores and has been downloaded over 70 million times with millions of monthly active users. Some notable Aussie brands who are cultivating healthier employee initiatives via Headspace for Work include Movember, Carsales.com, A2 Milk, Atlassian, University of Melbourne and Booking.com, just to name a few. We'll discuss trends happening within the mental wellbeing space. And I'll talk to EY economist Sherelle Murphy about Australia's inflation and what it means for the Reserve Bank of Australia and the prospect of rate cuts. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Wishing you all a safe and healthy week and looking forward to bringing Talking Business next week.